All right, hello, welcome to the Fastmarkets Future of Southern Yellow Pine webinar. My name is Joe Pruski, I'm the editor of Random Lengths. Over the next hour, we're going to hear presentations from a couple of people that many of you will be familiar with. First, we're going to hear from Dustin Jalbert. Dustin leads lumber analysis for Fastmarkets Wood Products team, where he's responsible for monthly lumber commentary and North American lumber forecasts, along with special client studies and consulting engagements. As a business economist, Dustin spent nearly a decade covering global forest products industry. Prior to joining Fastmarkets Wood Products team, Dustin provided support with forecasts and analysis related to single and multi-client studies. Dustin holds a bachelor's degree in economics and political science from the University of Maine and a master's in international finance and economics from Brandeis. Also joining us is Allison Coughlin. Allison is Director of Research and Product Development at CME Group. In this role, she designs commodity derivatives as well as maintains CME Group's benchmark agricultural products. Previously, Allison served the U.S. government in two capacities: as an international trade analyst for the U.S. International Trade Commission, where she both led and contributed to several studies on global agricultural trade and competitiveness, and later as a director with the Office of the United States Trade Representative, where she participated in negotiations on trade agreements. Allison graduated with a BS in International Resource and Consumer Economics from the University of Illinois at Urbana-Champaign, and with a Master of Public Policy degree from the University of Chicago. Thank you both for being here. A couple of quick housekeeping items. We should have some time at the end for questions. Please submit them through the button on your screen, and we'll get through as many as we can. Also, the session is being recorded. That recording will be available after we finish up. With that, let's jump in. Dustin, take it away.
Great. Thank you very much for the introduction, Joe, and welcome everybody. It's great to have you here today. I'm excited also to be sort of co-presenting with Allison from CME Group. I think she's going to have a lot of great insights on the new futures contract the CME has launched, and sort of talking a little bit about how, sort of the futures market is sort of having to adapt to some of the changes we're seeing in the softwood lumber market. So for my part of the talk today, I'm really going to talk about sort of the demand and supply balance of the North American softwood lumber market. And it's kind of the title of our presentation shows here, really kind of the growth of the Southern Yellow Pine market is really kind of instrumental to sort of the evolution of the market that we're seeing, and really kind of runs in contrast to what we're seeing in the rest of the sort of the supply side of the North American lumber market. So in my kind of piece today, I think if you want to take home one point on what's happening in the North American sort of industry for lumber, is that Southern Yellow Pine is going to continue to grow and take market share over the decade, and it's really going to drive end users and traders to adapt and evolve over time. That's really kind of underpins our forecast outlook, and there's a lot of reasons that we expect this rapid growth in Southern Yellow Pine and to take market share in the broader North American market. But I think you can kind of break it down into three big buckets in terms of the main drivers and that support that statement. First is the demand side. We really can't talk much about the supply side until we understand and have a sort of a context for where demand is going, right? And I think the good news for I think the industry is that we do expect solid demand growth over the next 5 years. And so I'll start talking about that in a few minutes. But then in that context, we know that supply has to sort of grow, right? So now we can kind of take sort of, take a look at the landscape here in North America and also globally and say, where is that lumber going to come from? And I think, sort of by deduction, we see that the South is really kind of the last game in town for incremental sort of sawlog availability and sort of softwood lumber growth to really meet the demand that we're expecting. And then finally, to kind of, the adaptation and the sort of evolution of the industry portion of that last statement really has to do with the fact that Southern Yellow Pine as a market operates a bit differently than the other species, the main dimensional lumber species that we typically associate with sort of the North American softwood lumber market. So We really have to kind of look at that. There's going to be factors that drive adoption of the species in this sort of the framing package mix or the broader consumption mix here in the US, but there's also going to be challenges ahead sort of adopting the species. And I think also the differentiation you see in the southern yellow pine market is also reflected in price correlations, which to some of the other framing lumber species, which will be kind of the last piece I talk on. So, let's talk about the demand outlook first. I'm going to try to move through this quickly. Again, I think, again, if you're a mill operator, you're a landowner, LBM dealer, distributor, I think the good news is over the next 5 years, our call at Fastmarkets, we expect demand to grow pretty robustly, despite some of the near-term challenges ahead for the softwood lumber market. And I don't like repeating or stating the obvious in our presentations, but I think it is important to establish and emphasize that wood products is really a housing story, right? And if you look at this based on our own estimates of end-use consumption for wood products, for the major wood product categories we cover, you can see that residential construction, new residential construction in purple, and repair and remodeling in teal, together account for somewhere about 70 to 75% of solid wood products demand in the US. And this is a snapshot specifically of 2022. And so, I think the new construction side in terms of housing starts and, housing starts and mobile home construction, people follow very closely, but I think the repair and remodeling piece sometimes gets forgotten. And actually for softwood lumber, repair and remodeling is actually the largest single end use category for consumption. So again, both those combined, as residential construction goes, so goes the wood products market here in North America. So you're probably looking at this and saying, okay, this is just a snapshot. What does this look like from a volume perspective and sort of over a historical time series? So the next chart really sort of meets both those sort of questions, and it's the same color scheme. So teal is R&R, and purple is new construction. And again, you can kind of see here that really, again, those residential construction and use markets really do drive total lumber consumption, which is measured in billions of board feet here. And in no place is it more obvious than the sort of the market downturn from 2005 to 2010. Obviously, that was disastrous for the industry. Folks who worked through that period, were in the industry that period of time, don't need to be reminded of that. But again, it does hit home the point that housing and sort of home improvement really do drive this market. If we kind of fast forward to the more recent history here, consumption really bumped up during the pandemic, but has been cooling down a bit here as we've had a big spike in mortgage rates, which has affected affordability for prospective home buyers. And certainly the repair and remodeling boom that really kind of drove the market is unwinding here to some extent, both, as fiscal stimulus sort of rolls off, people are participating in the service side of the economy again. All those factors sort of are relevant. And let me, I guess the last point, 2023, we're calling for consumption to drop off between 500 million to 1 billion board feet for the year. So not disastrous, but definitely sort of contributing to the very weak market and pricing conditions that we currently see in the North American softwood lumber market. The good news, though, is that we do think a recovery is sort of in the lurch here. And the reason for that is we think a couple things. One, the US economy is sort of working through these headwinds. We think the high interest rate environment we're seeing right now is going to start looking better next year as inflation rolls over. The labor market, while still resilient, is showing some signs of weakening. And as that does weaken, we do think the Fed will become more dovish in terms of its approach with interest rates, and that will kind of reaccelerate the sort of housing demand, the business cycle more broadly. So at a more fundamental level, we are still underbuilt in terms of our shelter needs here in the U.S. We probably need another 2 million units of home construction just to address vacancy rates here in the U.S. So we think the run rate for shelter production is probably going to be about 1.6 million units over the next 5 years. So we are sort of, and that factors in demographic demand as well as sort of this sort of underbuilding element. So we are expecting a reacceleration of demand once rates come off. And then the repair and remodeling side of the market also looks primed for reacceleration. When you think about rates coming off, households being able to tap into some of that pent up, home equity that's really built up with home price appreciation, growing real disposable income, structurally a tight resale market, so driving people to renovate their existing homes. We think all those factors are going to drive sort of solid growth in lumber demand over the next 5 years. And so we're calling for about 9 billion board feet of demand growth over that period, or about 18% cumulative growth. So that's a pretty good sort of demand profile ahead here. And we can debate the magnitude of the growth. There's some folks who are more bullish out there, some who are more bearish, especially on the near-term outlook. But I do think the vast majority of folks who sort of analyze the market largely agree that the picture is up and to the right in terms of the chart, right, where demand is going. So again, in that context, we have to ask the question, where is the supply going to come from going forward? And so when we kind of analyze the landscape here in North America, obviously we know about the challenges in British Columbia that, I'm not going to go into that piece of the puzzle at length because it is just so sort of heavily covered. Most folks know about the pine beetle kill impact and the declining annual allowable cut here in British Columbia that's driving closures of mill capacity that we've seen over the last few years and is continuing today. Of course, on top of that, sort of wildfires, duties on Canadian lumber by the U.S. Department of Commerce, all old growth policy that's gone in place in the province too. All these factors are also compounding on top of the pine beetle kill to really keep production costs very high for BC. So we know that these closures are in the works and will continue. But I think what is kind of missed in the grand scheme is we also at the same time have a historic build out and capacity that's going in the US South in the form of southern yellow pine. This chart just looks at the growth in capacity each year, in effective capacity in billions of board feet, and it breaks it down by the major supplying regions. And you can also see the net impact on total North American capacity in orange here. And so, you can see the big levers that are moving the capacity base in North America are, of course, the closures in British Columbia in dark blue, and then the red bars, which are the southern yellow pine expansion that I mentioned. And so again, you can see when you focus on British Columbia, we obviously have had these salvos of closures that coincide with really weak market conditions. We saw this in 2019 and that trickled into 2020. We're seeing this today. We think there's probably about 1.5 billion board feet of closures that will occur when all is said and done. So maybe another couple mill closures ahead, we think, given the weak market conditions. But again, you can see that the South's expansion in most years has more than compensated for these capacity losses in British Columbia, and that is going to continue going forward. We think at the pace of about 1 billion board feet of capacity a year. And our forecast is really kind of based, out to 2025 or 2026 is really based on actual project announcements. So there is this kind of slow burn of capacity that has been announced in the market from US and Canadian operators that are pivoting to the South alike, and that is going to keep the capacity base growing. So, we could talk at length about the drivers of this sort of boom and sort of expansion in the South over the last decade, and that will continue for at least the next 5 to 10 years. But I think at the most fundamental level, it really is a story about timber supply. There is an abundance of mature sawlog age material, timber in the US South that is keeping stumpage rates suppressed in that market. And that is really kind of a consequence of the downturn during the global financial crisis and the housing crash. So that is keeping wood costs very, very suppressed in the South. Meanwhile, sort of structural issues that I mentioned in British Columbia and similar fiber challenges in the Pacific Northwest are keeping log costs very elevated comparatively. This chart just shows our own estimates of gross delivered wood costs to the mill by major producing region. The South is in red, and you can see that it's really that delta compared to the high cost producing regions has really continued to expand over time. And this is driven sort of the capex that we're seeing in the South, the state of the art greenfield and brownfield investments, sort of incremental supply coming online. And we think that's going to continue. Our timber analysis shows that we don't think there's going to be a big convergence in the relative costs of production or the stumpage rates in those supplying markets, at least for the next 5 years. I think if you're talking 10 to 15 years, it's a different story. But at least in the near term, there's still investment, incentive to invest in the South when there's $100 to $150 per thousand board foot manufacturing cost advantage in that region, especially in the context of $400 to $500 price lumber that we're seeing right now. So when you kind of put the supply view and combine that with our demand outlook, you can kind of go through by the art of deduction and see that the South is kind of the last game in town. If we're going to grow demand by about 9 billion board feet a year, we're not going to really get a lot of supply from Canada to meet that growth in U.S. consumption. You can see that in blue at the bottom of the chart. And if you kind of work your way up the chart, again, British Columbia production is going to be constrained. And even with some of the incremental supply that comes in the other provinces in Canada, you're really not going to see much supply to meet that 9 billion board feet that we expect. Offshore supply, namely in the form of dimensional lumber from Europe, has helped fill the void in recent years, but we don't think that's going to really be a continued source of growth for a variety of reasons. One, Central Europe in particular has its own fiber challenges that it faces, and two, sanctions on Russian and Belarusian lumber to the European market will probably start to bite as the European economy reaccelerates in maybe 2024, 2025, and European sawmills sort of pivot to serve their own market as this Russian supply pulls back. So really, again, this kind of leaves the U.S. to serve its own supply needs going forward, and really the U.S. South is really the last game in town for economical fiber in a volume that can meet this demand need going forward. So we've talked about the consumption outlook. We've talked about how the South has this natural cost advantage that's going to help it sort of take share over time and sort of grow production compared to these higher cost supplying regions. But again, as I mentioned earlier, this is not going to sort of happen without hiccups, right? There's just a very different structure to the Southern Yellow Pine market compared to the other traditional, say, Western species that make up the dimension lumber market. Again, there's some factors that will drive adoption, but there's also some factors that are going to force sort of innovation and change in the broader sort of building materials market and the wood products market. So, just to kind of put a bow on things here, this is our production outlook for North America. And it is broken down by the U.S. South, or historically, and also the forecast outlook. And you can see the U.S. South in dark red, and the other U.S. in light red, and then Canada in blue. And you can see pretty clearly that the South has really been sort of grinding higher over time. But I think one important thing to note is that the non-Southern Yellow Pine species that make up, again, that really compose the other U.S. and Canada, so SPF, Doug fir, hem fir, fir larch, those kind of species, still make up the majority of volume in the market, and they will be a sizable share of the market going forward. So I want to emphasize that, and I think it's relevant, particularly for Allison's part of the discussion, that these species are going to be relevant going forward, especially in the context of the new kind of futures, more flexible futures contract that's been created. With that said, though, I mean, the South, if you look at this on a share basis, so this is basically the same chart, but it's looking at production, regional production as a share of total North American production, it is a lot more clear that the South's sort of share gains and sort of substitution to Southern Yellow Pine has really been going on for the better part of a half century, at least for what we have data for, right? So this is really not a very controversial statement when you look at the data. And I think what's even more interesting is that actually, as of last year, as of 2022, the South overtook Canada in terms of being the largest supplying region in North America. So again, this is, I think it's this webinar is very timely considering this sort of milestone that we hit, and we do think those share gains are going to continue for all the reasons I mentioned. And so because of that, there are sort of consequences, or there are things that market participants, whether you are an end user, whether you trade lumber, you're going to have to think about as the South sort of continues to sort of penetrate the US marketplace and the North American marketplace more broadly. So, what are some of the unique characteristics of Southern Yellow Pine and the Southern Yellow Pine market that are factors that will either drive adoption, which I'll be marking them with a green check mark, or will be challenges for the industry, which I'll mark with a red X. I have 5 here. I'm sure folks on the call could name a lot of others, but I think these are kind of the big ones to be thinking about. First is it's dominant in treated applications. So when you think about Southern Yellow Pine as a material, it's like a sponge. It takes the treating chemicals great. And in a lot of ways, it is it makes it differentiated from a lot of the other species more focused in sort of the framing grade lumber. So it is maybe a little bit more diversified into the repair and remodeling, the home sort of exterior home improvement markets. And that is going to expected to grow in the future. So that is kind of a source of adoption that we think is a tailwind for Southern Yellow Pine adoption going forward. Next, Southern Yellow Pine is traditionally a truck market. And when for those who are maybe less familiar with the lumber industry on the call, what I mean by truck market is most of the volume that shipped in terms of Southern Yellow Pine moves via flatbed. This contrasts with a lot of, say, Canadian lumber, Canadian SPF or Doug fir that actually moves via rail car. So the significance there is that you're talking about much smaller sort of loads, a fourth or a fifth of the size of a rail car that's being shipped. And you're talking about days until delivery versus weeks via a rail car. And I think that in the long run is playing out to be an advantage of Southern Yellow Pine, in that for buyers, it is a sort of source of managing price risk. If you're buying smaller, more frequent volumes and you're able to flip them within days, as opposed to uncertainty around late rail deliveries, things like that, that seems to be sort of a driver of adoption as well over time, and experimentation into new sort of end use applications. Related to the second point, but I put it as its own point, is the South's proximity to the booming sort of residential construction market in the U.S. South. That is a sort of that geographic advantage naturally lends itself to delivered price sort of advantages over some of the other Western species with a longer supply chain. We think this also is sort of a driver of adoption over time. And then when you look at some of the other factors that are a little bit more challenges that are going to drive sort of the changes in the innovation in the industry, we hear all about, Southern Yellow Pine, the challenge moving through zones due to stability challenges. If you're going from a high humidity zone to a low humidity zone, of course, the material can be susceptible to warp and twist if not sort of dealt with properly. And so this is going to force end users to think carefully about what applications is this material best used for, especially in the context of the framing package, and what zones can they move the material without dealing with some of these challenges. Certainly a lot of the capex and the investment in the South, especially on the drying and finishing end of these new mills, is mitigating some of these issues. But this is something that the industry is definitely thinking about. When we talk to home builders, we talk to sort of other converters, they're definitely looking long and hard about this at Southern Yellow Pine, because it is abundant. It's relatively abundant and cheap, but there are going to be challenges with adopting this material. I think really in truss manufacturing, component manufacturing, MSR, this seems to be the natural place it's being accepted in sort of framing packages. And then finally, and again, sort of related to point number 4, this is not really a typical reload product. Compared to SPF or Doug fir, which could sit in a reload for 6 months, maybe more. And there's probably folks with a differing opinion on the call how long you could hold Southern Yellow Pine in a sort of a warehouse environment. But it's not something that is typically going to sit in a warehouse for a period of time. It's a little bit more of a direct to market, direct to end user product. So if you have a distribution or wholesale model and it's sort of buy and hold sort of strategies, whether you're hedging or you're taking positions, this does kind of change the business model a little bit as the South continues to take share of the North American lumber market. So my last point in my presentation here is really to kind of look at the correlations of Southern Yellow Pine relative to the other species. And we do think some of these unique aspects of the Southern Yellow Pine market do manifest themselves in somewhat different price correlations. So this first kind of part of the chart just looks at the correlation of 4 key items to Western SPF 2 and better 2x4. And you can see there are 3 that are kind of sort of traditional Western dimensional lumber grades: fir larch, kiln dry Doug fir, and hem fir. And then we have Southern Yellow Pine East Side 2x4 as the proxy for Southern Yellow Pine. The sample period is a long sample. It's 10 years. I'm calling it the pre-pandemic period. And you can see that the price correlations are all very positive and very high across the board. But what is noticeable is when you look at Southern Yellow Pine East Side, it is noticeably 10 to 15 points lower on correlation compared to the other Western species. So it does seem like the South maybe moves a little bit more to the beat of its own drum, but it is still highly correlated over a long sample. These are somewhat substitutes in terms of the material that can be used in different applications. Another thing to note is when we kind of look at the pandemic period, correlation shot up across the board, and particularly for Southern Yellow Pine into and its correlation to Western SPF. I think that the way to think about this is the pandemic supply and demand shocks really kind of overrode any of sort of the regional species dynamics that sort of differentiated or kept the correlations from being one, let's say, right? But this is very similar to what we see in the stock market or financial markets when we see big macro shocks or natural disasters where asset classes that are not normally correlated, all of a sudden correlations go to 1, right? I think this is sort of what has happened during the pandemic between the different sort of species and items. Correlations have jumped up a lot, including for Southern Yellow Pine to Western SPF. The final point, and I think that this is probably the kind of the most important here, is while there are pretty high correlations across the board with for Southern Yellow Pine to Western SPF and the other species, over shorter samples, you do see more differentiation. The last 52 weeks, which has been sort of the unwind from the pandemic shocks, let's call it, you can see that correlations for both the Western species have, and Southern Yellow Pine have dropped off a lot to Western SPF, but Southern Yellow Pine has really dropped off a lot. We're talking a 30 to 40 point move downward in the correlations. So I think, we're going to see how this shakes out as we kind of get through the post-pandemic period here. But I think it does emphasize that there are periods of time where Southern Yellow Pine does kind of move to the beat of its own drum. And I think it has to do with the market structure, it being more of a truck market, it having a little bit more differentiated sort of end-use markets to some degree, proximity to the U.S. South, where construction is ongoing. I think all those factors are really important and can create these periods where there is some decoupling and correlations over these sort of smaller samples over time. So that's kind of summarizes my piece of the market overview here for Southern Yellow Pine and our view on the broader lumber market. Again, take home here, the South is going to continue to gain share over time and drive sort of adaptation in the market and drive substitution going forward. And really there are demand and supply fundamentals as well as market structure aspects that are going to sort of encourage that, but also be challenges going forward. So I think with that, Joe, I'll pass it back over to you.
Great, thank you, Dustin. It's really good stuff. Just a reminder, Please feel free to ask questions. There's a couple of them popping up here on my screen. Go ahead and use that button on your screen, and we will get to those at the end of the session here. We saw a lot of slides from Dustin there showing kind of changing wood products market in terms of production, species. This is something that our friends at CME Group are, of course, very much in tune with, evidenced by the launch of their new lumber contract, LBR, which replaced the legacy contract in May. We're going to hear a little bit more about that from Allison Coughlin. Allison, all yours.
Thank you so much, Joe. I am going to share some slides here as well. It is not coming up anymore. That's a problem. Thank you very much for allowing me to be here. I cover all ag products at the exchange, actually, except for livestock and dairy. So anytime I get a chance to talk a little bit about lumber, I am very thrilled. While I get this up, sorry, for some reason, it's just a little bit, it's not pulling up my PowerPoint tab. Today, I'm going to talk a little bit about how we see the evolution of lumber risk management and where we see CME's place in this market. Sorry, I don't know why it's not opening. Joe, do you have the slides by any chance?
Let's see.
Oh, here it is. Okay, just popped up again. Good. Hopefully you can all see that. Sorry for the slight delay. One thing we're not going to talk about today is trading strategies and sort of trade execution. So this is just our general disclaimer. Don't take anything that I'm saying as sort of trading advice in any sense. And I'm speaking for me and not necessarily on behalf of CME Group. So I like to start some of these presentations by talking a little bit about the three major responsibilities of my group within CME. And that's because really every product touches all three of these, and lumber, especially within the last couple of years, has we've done a lot of work on all three of these areas. So the first, which we won't get into too much on this webinar, but is content creation. That means writing papers, giving presentations, etc., doing some market education on our existing products and potentially how to use them. I think this, while we're not going to go into detail on this, some of the things that we've done in the past really highlight how exciting lumber has become in the last few years. So in 2022, I wrote a short paper on the supply and demand fundamentals of the lumber market. And that was our most read piece on our Open Markets website, you know, across all asset classes. And then just earlier this year, we did a TikTok on the housing market. And even without me having to do any super embarrassing dance moves or anything, I think we had close to like 70,000 views on that TikTok. So within the realm of CME Group, you know, lumber might not be the biggest product, but I do think it's exciting, it's interesting. There's a lot of demand and just sort of interest in the market in general. The two things that we will talk about a lot today are contract development and contract maintenance. So contract maintenance is ensuring that all of our existing products are meeting customer needs and are reflecting developments in the underlying cash market. So a lot of what Dustin talked about, even within the last 20 years, the lumber market has changed significantly. And our legacy LBS lumber contract had been around since the late 1960s. And that's actually sort of a baby within the agricultural world. Some of our contracts have been around for over 100 years. So it's really just ensuring that the products are working for our customers and that changes in the underlying markets are being understood and reflected in our products. And then contract development is exactly what it sounds like, listing new derivatives products, new futures and options to meet customer demand. making sure that we're getting the right contract specifications, writing the rule books, liaising with the CFTCR regulator on getting those products listed. So even though, yes, technically LBR was a new product as of last August, and there were significant changes that we made from the legacy product, the new LBR contract really emerged from contract maintenance. I've been at the exchange this is my 10th year. I've been managing lumber for about 7 years. And ever since I took over management of the product, we'd been hearing that the lumber market was fundamentally changing. Western SPF was, not just the entirety of the market like the contract was designed. So we sort of undertook a multi-year, for those on the call who were in the depths of it, they know, a multi-year endeavor to change LBS. That actually resulted in a new product, LBR, but really it stemmed from how do we maintain the existing product. Because there were so many fundamental changes, we made the choice to list a completely different and new product. It's pricing a different pricing point, it's pricing different lumber, different species. So in reality, we couldn't in good faith change the legacy contract to reflect those. It was a completely new and redesigned product. So one of the things that we heard from contract maintenance going out and talking to customers about what changes they needed to see was this list that you see up here. Obviously, Eastern SPF was growing. Mills were consolidating, so there were less maybe natural shorts in the marketplace on the Western SPF side. We looked at our deliverable species. You can see the map on the left, that the black line area was the entire delivery section, but then this pink area, which took up like a whole page of language in the rule book, was the hem fur carve out exceptions. And so I can't tell you the number of questions that I got on geographic origin when the legacy contract was still trading. So we tried to simplify that in terms of species. And the map on the right really just shows large production areas, but any lumber that's delivered via rail to Chicago in our species list is technically deliverable on the contract. And as I said, the legacy contract was a FOB Western SPF mill price. The new product is pricing a delivered product, delivered into Chicago. So I did get a lot of questions when the product launched about why there was this spread between LBS and LBR. That was essentially reflecting the freight, because it was the contract is still incredibly highly correlated with Western SPF. It's generally very easy to do the calculation of Western SPF or Eastern SPF plus freight to end up at the current LBR traded price. One of the major changes that I think has actually been really positive is the change to the contract size. So LBS was a rail car size contract. And even though the market, the SPF market still is heavily rail, transported via rail, when lumber shot up during COVID and even honestly around $600-ish, for the years prior to that, the notional value of 110,000 board feet on that excluded a lot of smaller to mid-sized participants that would have otherwise been interested in trading. And so we did sort of an audit among a lot of our existing contracts notional value, and that was one of the reasons that we went to a smaller contract size. So it is still traded very often in 4-lot increments, still delivered via rail car, but I think a smaller size gives significantly more flexibility to participants who do want to be in the market. I can't believe this slide. I put these slides together early in the week and it is already out of date. This is how how hot lumber is. We actually had, this says that there was a record options volume day last week. Yesterday was also now a new record options day in volume and in open interest. We are nearing 900 contracts of open interest in our options product, which is great. So we continue to see growth. We were over 8,000 contracts at one point. Now we are over 7,000 contracts in open interest. I think one of the main things that we're excited about is that lower cost to trade. The market in LBS was several ticks wide. Often the quantities on the bid and the offer were generally less deep than we're seeing now. So, you know, we see double-digit quantities on the bid side and on the offer side fairly regularly. We're seeing markets that are only 1 to 3 ticks wide, which is 50 cents to $1.50. Our average daily volume continues to grow. We're at over 800 contracts traded on average every single day. So we're really thrilled with the new uptake in this contract, and we're really proud of it. Like I say, I cover a multitude of products within the exchange, but this is very thrilling to get to work on a physically delivered, sort of reimagined, redesigned contract. And we love that the industry is using it and seems to be very excited about it and happy with how it's trading. So my first slide, like I said, was the 3 pillars of my team of research within the exchange. We talked a little bit about contract maintenance. Now I want to talk about how we look at new products, which I suspect and hope a lot of people here are very interested in. One thing that, like I said, we're not talking about trading strategies or trade execution. And I gave a presentation in Montreal at the Wood Convention about sort of general risk management 101. I'm not going to go into that here to sort of explain what futures are and how they can help. But if there are questions about that in the Q&A, I'm more than happy to talk about that. The only thing I'll say is often when people are new to futures, they think of futures as being inherently risky, or it's hard to dip your toe in the water. And my point is always, if you have physical exposure and you're not in the futures market and you're not hedging that off in futures, you're taking on more risk. So really, futures are there to ensure the market has a way to discover price and has a way to manage that price exposure and lay it off such that you're hedged via futures for your cash exposure. That being said, how do we get ideas for these new products? The best ideas always come from customers. We do a lot of desk research on how markets are changing, what new products are evolving, et cetera. But I can design the most beautiful, perfect, wonderful futures contract. And if the physical players in that market are not interested, it's never going to go anywhere. The biggest driver for me is customer demand. Are people asking me for it? Are people coming up to me and telling me, emailing me, talking to me at conferences about the need for this specific new product? We always are open to hearing new ideas. We love it. It's one of my favorite parts of my job, getting to explore these new markets and really dive deep in understanding the cash market. So that is our first step once we get inbound ideas or we generate internally some of those ideas. What does this market look like? You can see up here some of the questions that we just ask ourselves. So what is the general size? What does the makeup of the market look like? Are there a good amount of natural longs and natural shorts? What does the transportation system look like? Is there one key pricing point? Just sort of trying to understand the ins and outs, the supply and demand fundamentals of this market. And none of these are necessarily deal breakers, right? Not every market is going to hit every check mark for being a perfectly developed market ready for a derivatives product. But these are just things that we like to understand because I think it lets us better formulate a price risk management tool once we really get a lay of the land of what the underlying physical market structure looks like. And Dustin went into this, that was great. Are the prices correlated with an existing product? Oftentimes we hear that a customer may prefer a less precise hedge in a very liquid market versus a very precise hedge in a less liquid market. Because everyone wants liquidity. More volume and open interest, the better. You want to be able to get into the market and get out and execute what you need to. So one of the things that we take pretty seriously is looking at if a new product idea is already highly correlated with an existing product. Again, not necessarily a deal breaker. And I always tell people, you know, prices are highly correlated until they're not. They naturally break down. So over time is a great look, but it's not a predeterminant for whether or not a new product is eventually launched. And then once we understand the market fundamentals and how that underlying physical market is structured, we look at how can we design a product that reflects that. Our job is not to make a product that is going to change how the cash market works. It is to overlay a derivative on the way a market is already functioning. So we need to understand, are people going through brokers to get to, you know, do any execution? Are, you know, is it basically better as a screen product, or do people talk directly to each other and negotiate contracts, you know, independently? Is there one geographic location that emerges? You know, that's how we came up with the Chicago geographic point for the new contract, was hearing that Eastern SPF and Western SPF can both be delivered to Chicago. Listing cycle, all of these sound like very specific details, but they can really impact how well a contract takes off. What we've heard is, for example, Southern Yellow Pine is traded less far out than an SPF contract might be. So we wouldn't want to list something like 2 years of a contract if it only trades within the first 6 months on the curve. So we try to understand what these market looks like and start answering these questions in terms of, you know, what would the contract specifications look like? The last thing I have listed on here, we're going to get into more in depth on this next slide, but there are 2 methods of settling a product. And I do think there's some misconceptions about a financially settled instrument. So hopefully this slide clears some of these up. Again, happy to answer questions about this, but the LBR contract is physically delivered. That means that at expiry, buyers and sellers are physically exchanging that SPF lumber. The price is determined by a volume weighted average of trades within a certain amount of time on the last trading day. As I sort of alluded to or mentioned at the beginning, it takes a lot of time to set up. I worked on this LBR product for years and years and years before it launches, because we need to make sure it's designed as perfectly as possible, and our internal delivery system needs to be able to handle these new innovative delivery methods. So definitely very intensive internally to get up and running. Also, because people are physically exchanging the product at expiry, the market really needs pretty good deep liquidity pretty immediately for trust to be established. You know, no one wants to get stuck in a market, and so they need to be shown that they're going to be able to execute. So there's no sort of imminent threat of an uneconomic physical exchange. And because of the fact that the physical is exchanged, only participants who have inventory or who have a need for immediate inventory are participating as the contract nears expiry. Financial players are not interested in participating in physical delivery, and so the contract tends to roll liquidity a bit earlier than some of our cash settled products. On the other side, cash settlement, the final price comes from a price reporting agency. It's faster to get to market. It may not trade every single day, but if a product can sustain that, and we do see people carry their positions further into the contract month. The only thing that I really want to hammer on this, because I've gotten a lot of questions as we've talked about products with cash settlement, all types of like order types and things like that, and execution like exchange for physical are still absolutely allowed on cash settled contracts. They trade very similarly to a physical contract. It is merely the way that accounts are settled at the end of the expiry, at the end of the life of that contract, that really differs significantly in physical versus cash settlement. I know we're running up on time, so apologies that it took me a little bit to get the slides up, but this is really what I want people to take away from this presentation. Please, I am an open door. My email is my name at CME Group. You can also email lumber@cmegroup.com. We are interested in any and all feedback, whether that relates to our existing products, whether that relates to new product ideas, new product opportunities. We are always here to hear it. Interacting with traders and customers is such an exciting part of this job. And cash settled products, like the last slide showed, physical is not the only way to settle a product, as long as there is a reliable underlying index that the market trusts and the market feeds into, by reporting transactions. Cash settled contracts can work beautifully, and things like EFPs are still definitely allowed on cash products. So with that, I will stop sharing, and hopefully we still have some time left for questions.
Thanks, Allison. Can't help but think how many views that TikTok would have gotten had you done the embarrassing dance, but next time, yes. All right, let's see. We have, well, we have a little bit of time here. We can go a little bit over, about 10 minutes for questions. We do have some. I'm going to start with one right here. Get it off the board. Are we? Is the Southern Pine contract something that the CME would consider down the road?
Yeah, that's a great question, and I'm glad. Hopefully, a lot of people have this question. Yeah, absolutely. Like I said, I've been covering lumber for about 7 years. I've heard increasing customer demand for a Southern Yellow Pine product. Certainly, we don't commit to announcing any dates or real interest until it's internally approved and we've spoken to the CFTC. But like any new product, as long as people are asking us about it, we are interested in exploring it for sure.
Thanks. A couple more. We'll just stick with you for a second here, Allison. Given that SYP doesn't yard or store well over periods of time as compared to SPF, does CME become the tool for taking a long position without physically taking delivery of the wood?
Yeah, I mean, like I said, if it's a cash settled product, there is no physical exchange at the end of the contract expiry, but because you can EFP, you can certainly engage in obtaining or selling physical product through the exchange, through that EFP process. So that is one of the things that we had talked about as being a potential hurdle to an SYP product or a derivatives product, because really a lot of our agricultural markets are there to discover spreads and to discover the carry. And if there isn't that market structure, we have to think creatively about how we want to look at a product. So it is something that we're aware of, that it's not, I mean, SPF isn't necessarily inherently storable like a kernel of corn either, but it's certainly something that we're aware of. But if we looked at something, at launching something, it would not likely be a physical product, but you could still engage in the exchange for physical as a means of rolling on or off a position and buying or selling the physical product.
Okay. Got another one here. What about OSB contract for SME or CME panels? Any reason why that's any different?
No, there's no reason why that's different. We have heard actually relatively recently some significant demand for OSB. This was before my time, but I believe we had an OSB contract. On that front, one of the things that could be a struggle is I've heard the market is very disparate, meaning a lot of the pricing points don't necessarily correlate together or to one major pricing point. But like I said, none of the questions that I had listed or none of these are inherent deal breakers. We are always, always, always interested in exploring new products like OSB or paper or pulp or, lots of other products that have come up over the last decade.
Thanks, Allison. Got another one here for Dustin. The transition being made to SYP from traditional sources, do you really think Southern mills will continue to leave $150 per thousand on the table, or do you see the spread narrowing over time?
Well, so I think there may be some confusion on the slide there, because that was a reflection of their wood costs, right? So I mean, when you look at, the delivered prices to, whatever market, the delivered prices for, let's say, Western SPF, and Joe, you could talk to this better than I, but and say Southern Yellow Pine, they tend to be pretty close to each other over time. Obviously there's some delivery points, there's cost, delivery cost advantages for one species or the other. But that's the thing is, the South is not necessarily discounting aggressively. They just have wider margins because their production costs are so structurally lower because of the fiber advantage there. So
Okay. Another question on the optimism on the outlook for R&R. Comment that Harvard Lear is expecting a downturn.
yeah, so couple things. The lira is, and this kind of, not to pitch another one of our sort of things that we've created, but we've covered the R&R space pretty closely, especially recently. One disadvantage with the lira, it's a great resource. It is a dollar spend number, right? So and their forecast is not, it's based on sort of lagged data, the way that they forecast things. So so there's two pieces there. One, if there's sort of material cost deflation, that is sort of being reflected, that does not necessarily reflect the underlying volume of activity, right? So we have our own repair and remodeling index that we actually launched a few months ago. That is a proxy for volumes. And so what we see based on our kind of proprietary index, and it's reported monthly, is that repair and remodeling activity has, while it's come off pretty dramatically from the 2021 levels, it does seem to have bottomed out. Could it continue to sort of go downwards from here? It's possible. But I think the key here is that while there are drags from maybe the big sort of $50,000 and above pro renovation projects, the sort of smaller and medium-sized projects, the over-the-shoulder segment seems to have bottomed out and is potentially sort of reaccelerating. So we're optimistic that there's going to be a recovery in demand next year, now that this kind of goods to services shakeout has sort of been realized. But certainly, if the economy next year looks worse than we anticipate, the labor market really deteriorates, mortgage rates and interest rates go up, another 100, 200 basis points, certainly, maybe things are worse than we're calling for. So.
Okay. I'm gonna throw another one at you here, Dustin. Despite reasonable housing starts this year above predictions, end product prices have remained fairly muted. What does the inflection point look like for end product prices to improve late 24 or 25? What indicators should we be watching for?
Yeah, no, it's a good question. I think that the simple answer is there's just the industry operating rates are still too low right now. Certainly, we have seen some reacceleration in the new housing start side, especially in the single family side, which is good news. That's a big pocket of demand, right, for lumber. As I mentioned, though, repair and remodeling is resilient right now, but I don't think it's fair to say it's reaccelerating yet. So that pocket of demand, while bottoming out, hasn't really seen a big bounce yet. But again, next year we think that's happening. But the key right now is industry operating rates are below 80%, which is by historical standards, kind of the balance point we find is somewhere around 82, 83%. So we think it's really, even with you saw our demand outlook, we have a pretty strong demand recovery slated for next year. It's going to take all of that to get the market rebalanced. So we do think prices have probably bottomed out here, and we will start to see some reacceleration to next year. But the next 3 to 6 months could still be sloppy, especially as we kind of go into the weak seasonal period here with sort of the winter months. So it's gonna, there's probably still some pain ahead for the the wood product space.
All right, let's just keep going here. We have a couple minutes. Dustin, stick with you. I think lumber availability or lack thereof of sawmills and across the U.S. South will constrain SYP production. You touched on that a little bit, but yeah, what's the outlook look like?
Sorry, can you repeat that one more time? The first part of the question?
Do you think that labor availability in
Oh, yeah.
sawmills across the U.S. South will constrain SYP lumber production?
Okay, yeah, absolutely. So this is a big question, right? And we talk about this in our 5 and 15-year forecast. This is no doubt the downside risk to the supply outlook especially for SYP. You start looking at the pockets where there's mill construction and in pretty tight geographic areas and fiber baskets, and you start to wonder, how many loggers are there available? How many truckers are there available? And obviously, we tend to look at this at a macro level, but when you start looking at the micro level, you could, some of these hot sort of markets where we've seen expansion, especially, Mississippi, Arkansas, places like this, you really could run into sort of labor challenges. I think it's less so on the mill side. I think part of the advantage of these new state-of-the-art mills is that they're a lot more productive for the amount of board feet they produce. They're double or 2.5 times the average size of some of these older SYP sawmills, and they use effectively the same amount of labor, right? So there's a huge labor productivity advantage with these investments. But I do think that the question does become, what does the logging situation look like? What is the trucking situation? And that is to some extent going to be a governor on the speed of growth, and that is part of the reason we don't see the share of southern yellow pine, going exponential anytime soon. But it is going to grow. We think they're not putting these mills in places where they don't have a plan for how the labor and the log supply is going to be resolved. So.
Okay. Dustin, how will SYP growth impact markets that have traditionally been heavy SPF, Doug fir, hem fir? Meaning, to what extent do you see SYP growing in the Northeast, Midwest, and Western markets?
Yeah, it's a good question, right? I mean, I think the geographic question is always a key one. I mean, to us, so if I let me change this question a little bit. I think the key here is that the fastest growth in lumber consumption in North America is in the U.S. South, right? So if you think about the rate of adoption in terms of substitution, where you're facing the least amount of issues with the stability of the material moving through zones and whatnot, the South is the natural location where you're going to see adoption, and that's the fastest growing source of demand in North America, right? So in some ways, that puts a little bit less pressure on finding markets in some of these other zones. But without question, there's definitely parts of the Midwest that are seeing adoption, especially, MSR applications, truss manufacturing, panelized products. I think where there's probably more resistance is when you go out west, when you're moving to those drier zones, right? And I don't hear, about southern yellow pine in the Mountain West or the West Coast. Like, Joe, you could probably answer that better than I can. But I think that is probably where there's sort of some harder constraints. But there's southern yellow pine going to Canada. There's southern yellow pine. I mean, certainly it shows up in the Northeast in treated material, not so much as framing lumber. But I think, anywhere from the Mid-Atlantic to the Midwest is fair game for the material, so.
All right, I think that we've gotten through most of these here, and we're out of time. So thank you, Dustin Jalbert, Allison Coughlin, CME Group, for participating today. Thanks everyone on this call for spending the hour with us. We're going to have a link here in our webinar, in our chat, for the Fastmarkets North America conference, which is scheduled October 9 to 11 in Boston. Check out the information on that. Again, the recording will be available after we finish this momentarily. So thank you all for spending time with us. Have a great day.